CC Capital just put in a bid to buy Insignia Financial, a wealth management company listed on the ASX, for $2.9 billion. But it's not about this. It's not about that I want to talk about in this video. In this video, I want to talk about this interesting dynamic that I want other CEOs contemplating smaller transactions, smaller deals, to at least pay a listen. The lesson is, if you try to take over a company but lose out to a competitive bidder, right? A competing bidder, what do? In that case, you take over that competing bidder, right? And that's what happens in the CC Capital and Insignia Financial case. So CC Capital and Insignia, some years ago, 2020, both of them were trying to buy the National Australian Bank, their wealth management arm called LMC, MLC. CC Capital lost to Insignia to buy MLC. Fast forward 2025 now, and CC Capital is putting in a bid to acquire Insignia Financial. So the lesson here is that if you try to buy a company and this other aggressive bidder beat you out and take that deal off your hands, what you can do is to buy them up later. It's not always possible, but sometimes it does happen, and it's an interesting play. Now, who is CC Capital? CC Capital is a New York-based private equity firm headed or founded by a former Blackstone guy, Chin Chu. They haven't been around that long, I think, but I'm just curious why they want to get into Australia, specifically the wealth management space. If you look at Insignia's share performance since listing, the share price pretty much flatline. When Insignia first got listed, the share price was around $4, $3.56, and now it's still around $4, I think $4.05 or something. So they was first listed in 2003, so it's been nearly 22 years, and share price was the same. Imagine you were the investor, you bought in 2003, 22 years ago, and after 22 years you still where you were at 22 years ago. I don't follow the company, so I don't know, they might have had dividends over the years, but still, dividends alone is not good enough. Just like when you buy a house and you rent it out, all right? So your rental income pays for the mortgages. Let's say years later, without any capital appreciation, and just the rental income is not good enough, right? Similarly, when you buy a company, the rental, the dividends alone is not good enough. You want the company's value to go up as well. The fact that Insignia, after 22 years, still trading at the same spot. I don't know, the CC Capital guys might have some brilliant idea how to turn it around. Or maybe they gonna come in, use technology, get rid of a bunch of people. I don't know, but I think the financial advice, wealth advice industry has been going through a lot of challenges. I think the biggest risk with wealth management business is that the relationship with the customers lie with the person providing the advice, right? The financial advisor who has that relationship with the clients. So if that advisor moves to another firm, they could take the entire book with them to another firm. So I think that's the biggest risk for that, for the wealth management advice business. I don't know what CC Capital has in place, the plan they have to handle that risk in that business. But anyway, I just thought that it's an interesting dynamic I wanted to share with you, especially CEOs of smaller firms eyeing smaller transactions. Just know that sometimes, not all the time, but sometimes when a competitor steal your deal, right, win you in a bidding war, what you can do is you wait for the right time to take them over. The same way CC Capital is doing, right? While their offer is 40% premium to the price that Insignia was trading a month ago, before all this news about acquisitions came to the surface, came to the public market. But at $4.30, which is the price CC Capital is offering Insignia, that $4.30 is the valuation done by the 𝗱𝗶𝗹𝗀𝗶 Capital's analysts, and judging on the normal way analysts value a company, which is based on a standalone basis. If as a standalone, 𝗱𝗶𝗹𝗀𝗶 Capital's guy value Insignia at $4.30, that $4.30 would have not taken into account the potential synergies that CC Capital have available once they took over Insignia, because CC Capital has got some other related businesses in their portfolio. Potentially there may be synergies between Insignia and their other portfolio companies that have not been reflected into the $4.30 that the 𝗱𝗶𝗹𝗀𝗶 Capital's analysts came up with. So I think from a offer price standpoint, CC Capital has some more room to go up. So Insignia, hold out, because I think you can get a little bit more. But this is not financial advice. This is simply my personal opinion, personal assessment, personal evaluation of my personal reading of what's going on around this potential transaction. So again, not financial advice. Alrighty, that's all I want to share with you today. Again, the bottom line is this: sometimes, not all the time, sometimes if a competitor took away your deal, what you can do is to wait for the right time and take them over, right? The same way the CC Capital's guys are doing to Insignia Financial. They lost the LMC deal to Insignia in 2020. And now 2025, they pounce on Insignia because Insignia is not in a great shape at the moment, so it's the right time to pounce at them. All right, thanks for listening. See you in the next video.